All right. Okay. All right, guys. I think that we are finally back live. Okay. So just want to make sure everything is okay. Should be okay. Okay. So I see more people streaming in, guys. So sorry for the technical difficulties. There was some issue with our live just now. So if you can see me, right, if you can hear me, can you type hi in the chat or not? Okay, can you type hi in the chat? Okay, if you guys can see, just type hi in the chat. Okay, wonderful. Okay, so it works, okay, great. So I'm glad that all of you can hear me. So that is good. Right. Again, apologies for the technical difficulties. Now let's get started right away. Okay. I don't want to waste your time. So for today, right, what am I going to share with all of you is what we are going to talk about, the hidden risk behind the Magnificent Seven. Okay. Now, for those of you who know what is the Magnificent Seven companies, can you all type any one of the Mag 7 companies or not? Okay, if you know what any Magnificent Seven companies are, just type in the chat. Okay, what Magnificent Seven companies do you know? I'm pretty sure you can name at least one of them, right? One of them, your office, or the messaging app, right? Everyone will probably be using it. Some of them is some of you might be using this phone. Okay, so if you know any Mag 7 companies, just type in the chat. Okay, so I see that people saying Google, Meta, okay, Microsoft, wonderful. All right, so very good. Okay, and today, right, I know that Mag 7 has been something that all of us know on a day-to-day basis, and probably for most of you, you are also invested in Magnificent Seven. Okay, so for those of you who are wondering, okay, I'm sure all of you know, but this is just to share with all of you some of the companies, right? These are the Mag 7. Okay, from the left to the right, who do we have? We have Nvidia, we have Tesla, Microsoft, Meta, Amazon, Alphabet. Alphabet is Google, guys. And last but not least, Apple. Okay, so these are all the Magnificent Seven companies. And why do they call them Magnificent Seven? Is actually, there's a lot of other companies more, but it's because these are the companies that has been around for a long time. Everyone knows them by by the back of your hand. So that's why the market crowned them this name, the Magnificent Seven, and all these people that you see behind each of these logos, they are basically the CEO of these companies. Okay, and you guys know that in the United States, right? There is this big index that the world reference to, which is called the S&P 500. Okay, and the Magnificent Seven, they are also part of the S&P 500. Okay, so actually back in 2025 onwards, okay, so this 2025 year-to-date returns, you guys can see the returns of the Magnificent Seven. Okay, with Alphabet and Nvidia, on average, S&P is on average, it grew by 17%. But you look at how Alphabet and Nvidia and even Tesla, right, all beat the S&P last year, right? And even you see Microsoft, Meta, Apple, and Amazon, just for last year, it did not beat. Okay, but if you you zoom out in a 5-year period, right, all of the Magnificent Seven, right, all outperform the S&P 500. Okay, so you might be asking, hey, Bjorn, so okay, what are the hidden risks of the Mag 7? Okay, slow down, because today I need to share with you guys context first, okay, on what the Mag 7 is as well, and then we'll look at what are actually the hidden risks, because all this plays into effect. Even this chart where you see the returns are very, very high, right? Like what Shengli said, market share the most exactly. Right. And for those of you who don't know, right, this live came at a very good time. Okay, why do I say it's a very good time? Because literally this week, guys, this week on Thursday, we have most of the Mag 7 reporting their earnings, right? Reporting their earnings. So you can see, I'm going to draw my pen out and circle. So Microsoft, Meta, you can see Tesla, Apple over here. I don't know if I miss any out, but you can see 4 of the magnificent 7 companies are reporting the earnings this week. So this week, guys, is going to be a very, very exciting week. And I can tell you that the whole world, that everyone will be looking forward to this earnings. Why? Because you guys know that, maybe let me know in the chat, what is something that you know that every single one, not just the magnificent 7 companies, every single company in the world is trying to do more of. Okay, what is that thing that every single company in the world is trying to do more of? Okay, it's basically 2 letters. So if you know what is it, I want you to type in the chat. Okay, for most of you, you will probably know it. Okay, everyone is just fighting for a piece of this pie. Okay, where it is something that in the next 5 years, people are saying that the demand is going to be huge. Jobs are going to be lost because of that, and everything will change. Okay, so what is this 2 letters word that all of these companies are fighting to get a piece of? So if you know, just type in the chat. Okay, so I see some of you are already typing it, right? AI, exactly, right? AI, right? They are all in AI, and as you know, because of how the market has been looking for all of these companies, right? When you look at how their performance is, right? This is their valuations, right? Because when we look at the valuations of the companies in the world, right, it is an indicator of where we are in the market right now in today's days and age. Okay, so what are we looking at over here? Okay, for those of you who also know, you know that the Mac 7 comprises a huge part of the S&P 500 actually. So you can see, right, just to share first, in the 2000 tech bubble, right, Magnificent 7 was just 27% of the S&P 500. In 2000, in today's context, 25 years later, right, it is like 40%, 40% of the entire S&P 500. Okay, so why is something that this is like a hidden risk that we have to take for, right? It's because when anything happens to the Magnificent 7 companies, right, it's going to affect the S&P 500. And the S&P 500 is an indicator to the overall economy, right? People look at it as a benchmark. So as a percentage increase, it becomes more concentrated, right? And when it becomes more concentrated, that is where there is this thing where if any pullbacks were to happen, right, that's where it will affect the stock market. Okay, so this is actually one of the hidden risks of not just individual companies, but when we look at the Magnificent 7 together. And if you look at how the PE multiple is, the price to earning multiple of the S&P 500 is right now, this is the 10 largest stock. Okay, and of course, inside these 10 largest stock, what do we have inside here? Of course, we have our M7, which is our Magnificent 7 over here. Right, so you can see, right, back in the 2000 tech bubble, right, the top 10 stock was 43%, so it's still incredibly huge. Okay, and if you look at today's context, right, back in 2025, which is around here where we are right now, we are roughly at 31x right now. Okay, is it excessive or not? Is the valuations excessive as compared to the tech bubble? I mean, you just see the gap here. Not exactly, not extensive. But guys, at over here, right, in the 2000s, how the top 10 stocks valuations are 2 times of the S&P 500, excluding the top 10 stocks. But right now, like back in 2022, at this point where it's 36, guys, this was 1.5 times. Okay, 1.5 times. Okay, you can just do the math. And right now, where we are now, guys, we are also at 1.5 times. Okay, in terms of how the valuations are. Okay, so you can see very clearly just from the PE multiple of how the companies are earning, we are in that territory of stretch valuations. Okay, not to the extent of the tech bubble, but we are in that territory, right? So this is the thing that you know, when we look at individual companies of the Max 7, that's something we want to consider is as a percentage of the whole S&P, with them comprising 40% of it, right? How overvalued are the top 10 companies, where the 7 of the top 10 are the Max 7. So you can see this is the first thing that I want to share with you of how it looks elevated in a way. Okay, so and what happens, right, when valuations become elevated, okay, and the company reports earnings that is not something that the market likes? Okay, what happens to a company like that? Okay, now let me share with you something about some of the companies here, and one of it is this company called Broadcom. Okay, so for those of you who don't know, right, Broadcom is in the semiconductor space. They are actually a manufacturer in that space. They are not a Max 7 company, but they have been around since very, very long time, more than 10, 20 years. Okay, and if we look at the share price of Broadcom, right, you can see that actually, let me stop share and I'll share with you very quickly Broadcom share price. Okay, so let me share my screen again and you will know what I mean over here. Okay, so where is AVGO, which is Broadcom? You can see that on a 5-year basis, Broadcom is up 600%. Guys, 600%. Right, and of course, because they are the benefactor of the AI boom. But I want to zoom in your attention, right, to what happened actually back in 10 December. You can see before 10 December, how was Broadcom running? Well, it was on a massive tear, man, from the low of 154 back in April, right? It rallied all the way up until $400. It's a 200% return, close to 200% return in a matter of 8 months. But what happened right after that on 12th of December? Boom, straight away, it dropped 15%, 16%. And why did they drop? It's not because their numbers were bad. It's not because the numbers were bad. The numbers, in fact, their earnings was amazing, right? AVGO earnings, right? If you look at the earnings, if you look at their news, December, okay, December 2025, right? So you can see AVGO, okay, let me just see the news, it'll be easier, right? If you see the news, AVGO, right, over here, Broadcom shares slide after investors seek bigger AI payoff, right? Broadcom turning strong earnings. So what happened, right? What happened? It is because of, number one, even though the outlook is good, but because people were looking at their what they call the margins, where it is not as strong as they expected. And you can see just because of that one little thing that people expect and it didn't, right? Literally, in one single day, it dropped by 16% for a company that is $1.5 trillion. Okay, so that is a huge drop for a company that size to drop 15% in one day. It is actually very, very huge, right? And this is a very good, why I want to share this is to share with you that because for them, they are actually considered a heavyweight in the stock market. Okay, so you can see that for them as a heavyweight, the moment something miss, a little thing miss, right, they drop by 16%, right? So what, and because it's also for them, their valuations were also stretched. Okay, so this is not 1.6%, it's actually 16%. The valuations were also stretched from there. Okay, and that's why, right, when things have run up too much, when things are at these excessive valuations, if there's just anything that is not right, people kind of sense that it's not good, is an excuse to sell down the stock, right? This is what we call this term called price to perfection. Okay, type in the chat PTP. PTP stands for price to perfection. Okay, Broadcom is an example. Another one is Oracle, which I'm sure that some of you who are working, some of your companies might actually be using Oracle. And if you look at Oracle share price, you can Google and see also on a massive tear upwards. And what happened was the same thing, right? They released good results. Their guidance was good, but they said that, oh, our spending is going to increase. And bam, the stock just created from there as well. Okay, not just Oracle, HP as well, right? Profit pressure in late 2026 due to surging memory chip costs. And later on, we have one more case study to share with you all this. But the whole idea, right, of why I'm sharing with you this is to share with you that to pair on with the risk of how an overvalued company, right, when things are not as perfect as it seems, because people is expecting them to perform like 100 over 100 marks, that kind, right? Is it possible? Of course it is possible. But the moment, even if the company does 99 over 100, which is an outstanding result, the market don't like it. They want 100 over 100. Okay, and this is what many people are not talking about. Many people are just saying that, oh, just go and buy, valuations become steeper. To a certain extent, yes, right? But when it pulls up too much, there's something where, in terms of the things that that you want to do, you also don't want to be chased and be super aggressive as well. Okay, so this is what I want to share, right? Now, so in terms of valuations, right, we can see that, okay, one thing is the company that reports their earnings, and their earnings are not good, right? And so valuations will actually will get smacked down, right? The earnings are not good. Now, another thing which I want to share with you, right, is this thing called it's actually rate cuts, which is also a threat to valuations, okay? Sensitivity to rates, okay? Now, how does this seesaw works? Okay, so you can see two boxes over here. Okay, now to put it simply, right, how it works is this. So you know that in the world, the market, right, is affected by two main things. Number one is companies' earnings, right? They look at how the companies earn, and they follow the fundamentals of the company, and they assign a rate, right? And of course, there's also market expectations, right? But one thing that affects, right, the valuations, right, is this thing called interest rates. So can all of you type IR in the chat? IR stands for interest rates, which is what we are all familiar of, the federal funds interest rates. Okay, now to explain it simply, right, I want you to imagine right now you are a business. Okay, right now you are a business, right, and you want to invest in another company. Okay, now the bank is offering you how much? The bank is offering you let's say offering you 2.5% interest to borrow money, right? And then yeah, okay, maybe you think 2.5% is reasonable, and so you let me just borrow the money, and I invest in a company. Okay, because the company, right, if you borrow and you need to pay 2.5%, you just need the company to perform more than 2.5%, and you already make more money. Okay, now what if now the bank tells you to say that, hey, sorry, now no more 2.5%. Now you need to pay me 5%. No more 2.5%. Now you lend me money, you need to pay 5%. Okay, how does this affect valuations? Now, instead of you having that benchmark of just 2.5% to beat for your investments, the money you use to invest, or there's other people okay, in real life, don't do that guys. Now instead of 2.5%, you need to meet 5%. Okay, minimum 5%. Okay, so that means now you need the company to do even better, not just 4%, not just 4.5%. You need it to do it more than 5% in order for it to be worth your time. Okay, so what does this mean? It means that in terms of valuations, right, one of the most popular valuation metric we have around is called the discounted cash flow valuation metric. Okay, in short, we call it the DCF. Okay, can all of you type DCF in the chat? So how does this discounted cash flow valuation model works is you assign this what we call a discount rate to discount the future value of cash flow to present value. Okay, for those of you who don't understand much, it's fine, no problem, right? But the whole idea I want to share with you is this. Just think of now, the company, right, has to perform even better than 5%, right? Because now my interest rate, instead of 2.5, it is 5%, right? So when the interest rate or cost of capital increase, the valuations of the company will drop. The companies, right, people will assign a lower valuation to it, right? Because now the future value is worth lesser, because now the interest rate increase, right? But this is just to share with you, is this, let's say right now, is this considered a risk or a threat or not? No, not really. Okay, why? is because the Federal Funds Reserve Rate, again, I'm going to stop share screen. For those of you who are following, right? Why is this not a threat as of this current time? It is because of the Federal Funds Reserve Rate, Federal Funds Rate, of them cutting the rates. Right now, we are in an environment where we are cutting the rates, and there is no rate increase environment right now. So right now, you see our rate is 3.350 to 375. Okay, and you can see the target rate probability. What are the two target rates? It is either to cut 325 to 350 or maintain at 350 to 375. So the probability that we see now is for the rates to maintain, not to increase. Okay, so we are safe for now. Okay, because if we ever come to a place where the federal funds want to increase interest rate, just like back in COVID 2021, when they start to increase rates, that period is a perfect example. Okay, it's a perfect example of what will happen if we are in a rate hike environment, increase the rates. So I'm in the S&P chart right now. This is the period from 2022 onwards. This whole box, right, is when we started to enter in a rate cut environment. And you can see how the valuation compressed every single month from there. Is because the rate hikes were coming like very, very quickly in the year itself. So you can see the moment rate hikes come in, valuations will get compressed. Okay, and that's where, again, if the valuations are elevated, right? Okay, I ask you, if let's say, right, imagine a balloon, okay, it's not a bubble, okay, I'm not talking about AI bubble, just imagine now visually, you blow a balloon, you keep blow until the balloon so big, okay? Imagine right now, you start to release the air just a little bit first. Do you think that air will rush out very, very, very quickly or very, very slowly? Okay, quickly type Q, slowly type S. Okay, so that's the analogy that I want to share with you, because the moment you open it, it's like you're doing a rate cut. That's where the valuations will start to compress because it's so big already, right? So the moment you release a bit, right, it will compress very, very quickly, especially if it's elevated. Okay, so this is how the current market looks like, and together with how this valuation trend appears, especially when we are talking about rate cuts. Okay, so this is the first thing that I want to share with all of you. Okay, the first hidden risk, which is now in terms of the Max 7, we do see valuations being a little bit stretched. Okay, now will it be stretched? Can it continue to be stretched in the next few months or year? It's definitely possible, right? So that is why there are other metrics that we also want to consider, not just this. Okay, so yeah, okay, so if you I can see, okay, I see only 2 people type, guys. Okay, come, just interact with me, okay. I think today's will actually help you, especially this week, guys, is going to have a lot of exciting things happening. Okay, so I want you guys to really pay attention to this, because this for those of you who are just starting out, or for those of you who are very experienced, this will be very, very applicable to all of you. Okay, now let's move on to the next part, okay, which is the next risk. Okay, the next risk is this AI spending. Okay, so let me write what this this is hidden risk to HR2. Now, this was back in November. AI spending may slow down as ROI remain elusive. Okay, now, so I'm sure all of you know, right? Actually, for the second half, Q4 last year, wow, there were a lot of spending, a lot of money being plowed into a lot of these AI companies, right? Left, right, center, all the deals are being made. Okay, which is people are like front loading a lot of things, a lot of the money, like just invest, right? But what do you notice is that from December onwards, and so far in January, right, there has been a lack of all of these news, right? You rarely see a lot of money floating around, a lot of people saying that investment, they are investing in this and that, a lot lesser than before. And why? It's because people are starting to realize that, hey, I cannot just plow money into everything. I need to make sure that that it is making money, right? That my investments that I put money is making money. Now, if you dig deeper in this article, here's what it says, right? Most enterprise have yet to see their AI investments make a positive impact on the bottom lines, which could lead to many to rethink AI budget over the next year, right? Okay, and many enterprise will delay a quarter of their planned AI spending until 2027 as they struggle to see a return on investment, right? Because this is the fact about investing, right? When you put money into to any company, right? You of course want the company to make money lah, correct or not? Right? You just of course want to put. So a lot of times what happened in the early days, even during COVID, is like people are just like raising money, putting money and pushing money inside the into companies, right? But then end of the day, the money literally vaporized because a lot of these companies are not making money, right? And that's what we are seeing right now, right? You can see the disconnect between the inflated promise of AI vendors and the value created for enterprise will force market correction, right? Of course, this is what the analyst write. This is his own personal opinion, right? So we cannot say, oh, the market correction is coming. Okay, that is not true. That is not what I'm trying to say. But what we want to think of this kind of article is to know that how investments are actually slowing down because people are rethinking of the ROI, whether it will actually make them money. Okay, now what does this affect? Okay, what companies does this affect? Of course, it affects the Max 7, but there is one company that has been at the center of a lot of this AI investment, and it is this company called OpenAI. Can all of you type in the chat OpenAI? Okay, founded by this guy called Sam Altman, right? We all know that in 2022, right? That was 2021. That was when ChatGPT first came out. I remember clearly that day in November 2021, where I saw one of my colleagues, right? It was still ChatGPT 3.5. And he asked a question and the AI responded directly. I was so freaking amazed. That was when GPT just released a few days only, right? So I was so freaking amazed. And that was just how many years ago? 4 years ago. And now you can see how fast we have advanced over there as well in terms of AI. And you can see OpenAI faces make or break year as profit pressures build. Right? Then a lot of money has been pushed to OpenAI. But guys, they are still facing 7 billion of annual cost and investor pressure ahead of potential IPO this year or next year, targeting 1 trillion in valuations, right? So until today, right, even though they have been the center of a lot of money raising, which I'll show a chart later, they are not profitable. Guys, let me ask you, when a company is not profitable for so long and they are burning money year after year, and now that investments are slowing down, what is the worst case scenario that might happen? Type in the chat. Okay, again, if investments are slowing down and the company who is at the center of these investments they are losing money every single quarter, billions of dollars, what is the worst case scenario that will happen? Type in the chat. Okay, now they'll probably go bankrupt, right? That is the worst case scenario. Okay, and you might think, well, okay, OpenAI, right? How does this affect the Max 7? Okay, now this is where I want to share with you these okay, so you can see this is also a part of the valuations to share with you on how Max 7 is right now. Okay, but more important than these apart from these valuations one that you saw, more important than that is this. Okay, now you can see there's a lot of things happening a lot of ding dong back and forth going on over here okay, but what you will see a lot of these at the center of everything okay, even though you see NVIDIA at the center, right, the center of it all is actually OpenAI because it all started from there, right? This is what we call like this is actually a loop that people are saying that it feels like everyone is going round and round to do the same thing, right? You can see OpenAI to spend 38 billion on AWS, then AWS invest 8 billion in Anthropic, then it goes down to here. Then where is the money over here? $300 billion deal for OpenAI to use Oracle AI infrastructure. then multi-billion-dollar deal, you know. But basically, guys, everything that you see here is all interlinked. Okay, so Meta. Okay, so now we see the Mac 7 here. Okay, Meta, Google, Anthropic. Okay, Anthropic and Amazon is the same thing lah. AMD, Oracle, Nvidia, Microsoft. Guys, these are the companies. Mac 7. Yes, they are profitable, and in the long term, right, they will be fine. Okay, they will be fine. But guys, I want to ask all of you. This is OpenAI, and we saw that they are losing money every single quarter, right? What happens when this is gone? What's going to happen? What's going to happen to this whole flow that is back and forth, right? This multi-million-dollar deal is gone, okay? When this multi-billion-dollar deal is gone, then what else is going to happen? Will this be gone? This $6 billion to purchase obligation, maybe it'll still be here. Meta to use core, maybe they'll still earn this, right? Microsoft invest 13 billion in OpenAI, this will be gone. Okay, OpenAI to spend, this will be gone. You affect this, right? Then Amazon Web Services revenue will drop, right? Because there's no more. Then you can see it affects every single thing. This will be gone as well. Oracle will be affected, right? So you can see, right? Everything is like a domino like that. Everything will start to collapse. It's because OpenAI is at where? OpenAI is at the center of everything, of the Mac 7. So anything that will affect the OpenAI, it will cause what I call a ripple effect. Okay, can all of you type ripple in the chat? RIPPLE. It will cause a ripple effect to flow down to all of these companies, right? Okay, because on one way or the other, they are connected. So if one says oh shit, I'm going bankrupt, right? It's going to affect other companies in terms of the deals they have, in terms of the investment they have. And when that happens, I hope it's a when, I hope it's a if, it's not a when. Okay, that's where you start to see Mac 7 being affected. That is the risk, because everyone is connected to OpenAI one way or the other, right? Can you guys see that? If you guys know what I'm talking about, can you type in a way 7 in the chat? 7 for Mac 7. Okay, so this is the second thing that I want to share with all of you lah, right? That is very important for us to know about what is happening to OpenAI as well as the valuations. Why? Because even the smallest move can rock the boat, as what you have seen from Broadcom, as what you've seen from Oracle. Now we haven't seen this in Mac 7, and if it ever happens, will the impact be huge or not? Might not be. It might not be super huge, but might it be at the level of Broadcom levels impact? Possible, because Broadcom, a $1.5 trillion company, can drop 16% just like that on a little shake rock of the boat. Okay, but in today's context, we don't just have OpenAI to consider. We don't just have valuations to consider, right? We have other stuff to consider. And this brings me to the hidden risk number 3. And it's not just a single risk, it is a accumulation of risks. Okay, I call it the macro risk. Okay, and a few layers to this. The first layer is this. And this just came out actually yesterday. There are talks of another US government shutdown. 3 months after we had that government shutdown, the longest government shutdown in history, right now we have another talk. Okay, another people are saying that, oh my God, there's going to be another government shutdown. Right, this is poly market. This is a prediction market. Now, might this be 100% true? No, it might not be, but this is a very good guideline of a lot of things happening. So like, insider and people take reference on this to know the probability of something, right? So you can see, guys, it was dropping, guys, to below 20%, and now it is up. Just yesterday, up a 80% chance that there will be another government shutdown. Okay, now how will government shutdown affect us? We the last government shutdown, it was the longest one, right? So when it went towards the longest day, right, the market started to get jittery. So that was back in November, right, where we had quite a bit of a correction then. So this is the first thing that people will be looking at. Okay, the first one, macro risk, government shutdown, all these little stuff that will affect. The second one is something that all of you, some of you might know, some of you might not know, but it's related to our favorite guy, Okay, anyone knows who is our favorite guy now? Okay, if you know who is our favorite guy, please type in the chat. His name starts with T. Okay, one syllabus only. Okay, who is our favorite guy? Just type in the chat. Okay. This is this is what's happening lah, right? Where actually from last week we just had the tariffs with the European Union. And this week, what is our tariff now? Is to Canada. Trump threatens Canada with 100% tariffs if he makes a deal with China. Okay, now we have tariffs back on board again, right? Now some of you might be thinking, hey, I mean, yeah lah, last time it was China. China, okay, it was quite jialat. The last week one was Greenland, Europe. Wow, that one even more jialat because it involves more nation. And right now is Canada. Okay lah, not so bad. True, okay, it might not be as bad as what we saw in the past two ones, but you must know that the market, right, is a mixture of different factors, not just one event. Okay, like the government shutdown, it plays a part to how the market reacts to this kind of macro news as well. Okay, so and this is it, the Trump's Canada one. And even though Canada has also responded and say that you know, they are not going to make a deal with China, right? But the market is still reacting it. Okay, so these are the two things. Now there's one more thing, and it's actually something that not a lot of people are talking about. Right, everyone in the media is only talking about the government shutdown. It's only talking about the Canada's tariff. But there is one last thing, which is all Singaporeans' favorite destination, and that itself, what is happening to that country, is affecting us, affecting the global economy. Okay, it is actually Japan. Okay, Japan. Okay, for those of you who have been to Japan or who want to go to Japan, just type JP in the chat. Okay, now Japan, guys, apart from it being a place that we all love to go, because now exchange rate $1 to 120 yen, it is amazing. Yes, I agree. But as in terms of the global economy, guys, I want you to bring you guys back in during the 1990s. So during the 1990s, actually before, it was 80s to 90s, Japan was the #1 economy in the world, right? Everyone was, they were leading, right? They were the leading economy. And after the 1990s, you know, they did a massive, I believe it was a rate cut or something like that. I cannot exactly remember. But since the 1990s, right, the Japan stock market has actually never recovered back to that level. It has literally just went down all the way since then. And over the past, and they called that period from the 1990s until now the lost decades. Literally, there's a term. You all just type in the chat LOSTDECADES, lost decades. Just go and Google and read about it. It's very, very interesting. So and because the Japan interest rates were at 0% and like even negative interest rate, which means that you borrow yen, people pay you money, right? So what happened, right? Because they were once a global superpower, what big people do, right? Big, huge investors, hedge funds do, right? Is that they borrow, they go and take a loan on yen because it's literally 0 interest rates, and they change it to USD and they invest in US assets. It's literally free money. It's literally a free money printer, right? Because you don't have to pay any interest rates on Japanese yen. And people just get the USD and they invest in USD assets. Okay, so what is happening right now in Japan? For those of you who don't know, okay, I share with you the chart again. So let me share my screen again. Okay, so I'll use Sing dollar so all of you will be able to see it. Okay, let me share my screen once again. So if you look at SGD to yen, guys, you all see something. You all see in 1 month, right? And actually just see 1 year. You can see how yen since April last year. Wow, I tell you, you've been to Japan, you must know how this feels. Okay, you can see how the yen has been weakening. This means the yen weakening. Because for us, for those of you who are in Singapore, you are getting more Japanese yen for 1 Sing dollars. Right? So this is 1 year. You can see the yen has been weakening super, super strong. And what happened literally just yesterday is that actually on 22 Jan, last Friday, is that suddenly it just collapsed like that. It is quite a big thing. It's quite big. It dropped 2%. Okay, 2% in the matter of like 3 days, 4 days. right? This is actually big in terms of how currency moves. 2% in a matter of actually just 2 days, right? 2%, right? Not counting the weekends. Right, and what this happened, right? Why is this happening, right? Is because the yen is weakening, and there are chatters, chatters that either the US or the Japanese government themselves are going to step in to support the yen, right? And when the yen increases, guys, when the yen strengthens, actually, right, for those people, right, imagine for those people who bought yen at a very cheap price, now they have to pay back, they have to pay more yen for the same level of USD, right? So, and this is why today's, right, not just the government shutdown, not just the China trade war, but because of this as well, that we are looking at market being a little bit red today, right? And this is the macro risk I'm talking about in the Max 7, and I will also argue that it flows down to the rest of the stock market as well. Okay, because of how Japan is very vital, is very crucial to the world economy. Okay, so and all of this it all affects the valuations, right? The moment where something is not very nice, okay, be it macro and stuff, you start to see Max 7 companies, and if you have actually seen it, actually for this month itself in January, right, Magnificent 7 returns has been sideways, never really returned any and returned much. It's because people know that the valuations are a bit on the higher side, and people are not like wanting to plow in. After all, Nvidia is a $5 trillion company, right? It's one of the biggest listed company right now. Okay, and so this is macro risk. And one more thing is, fear and greed index, guys, we are only in neutral, and we are moving towards guys. We are moving towards greed. We are moving towards greed. So you think of it, things are becoming more and more expensive, but people are becoming potentially neutral now, but becoming more and more greedy. Okay, guys, are you able to kind of like sense where I'm coming from or not? About how the market and how Max 7 these are the risks hidden involved, that is present, right? Of course, yes, 5 6 years later, these companies will do very well, right? But of course, for us as investors, right, we also don't want to be blind and just immediately just buy and just buy. Because why? In the short term, right, even though we know that in the short term it doesn't matter, but it affects us, right? You will feel very emotional knowing that, wow, shit, I bought at a high, right? So that is the reason why that we understand all of these hidden risks, to know how to better position ourselves as investor, right? Okay, so what actually happens when the music stops? Okay, what happens when one fine day something happens? Okay, now this is where I'd like to share with you a case study from Intel. Okay, Intel. But before that, guys, before I share with you this, okay, if you want to know how we actually look at these companies, right? So I share with you how is overvalued, right? How each of these companies are overvalued, But if you want to know how to actually value them, right? How to actually value these companies, right? I want to introduce you to this. I want to introduce you to our Buffett Accelerator framework over here. Okay, so over this framework is what we use, right, to analyze companies. Okay, to analyze companies and to determine their valuations. Okay, and not just that, right, we use it through time-tested principles over decades, and principles that are learned, that are being from Warren Buffett himself over here. Okay, so in this Buffett Accelerator framework, right, my partner Rachel will run through the same approach inspired by Buffett's principle to learn about the valuations and to understand about how to better position yourself, right, so that you know when to buy these companies at the right time, and also using right options strategy, right? So, but guys, this thing is free to join, guys. Really, it's totally free to join. It's a 2 hours workshop. But one thing I want to share is you need to secure your spot. You need to grab your spot, right? In fact, our next session is tomorrow, and I think we literally only have, like, last I checked, it was about like 3 spots left, right? So if you want to learn this, right, go and scan this QR code, join this 2 hours class, okay, and set a time for tomorrow. It's going to happen at 8 p.m. Okay, and this is the exact framework that we use to teach students and to learn how to better position ourselves, to learn how to better identify when is a good time to buy these companies, as well as to find new companies as well out of the Max 7. Okay, so again, if you are interested, scan the QR code on the screen or click the link in the chat down below. All right, okay, now let's move on to the next part of it, which is the case study. Okay, now this is similar to Broadcom, guys. So actually in Intel, right, they actually just released their Q4 earnings just late last week, right? And they topped the Q4 estimates. Okay, and you guys know Intel has been running like crazy, guys. Literally in January, it was up 23%. Just in January, it was up 23%. And everyone was expecting their earnings to be blow out, to be freaking amazing. But what they say, the Q1 outlook was below forecast. Straight away, smackdown down 16%. Guys, this is what I mean. When you see a company that has run up too far ahead of itself, right? This is the kind of thing that I'm talking about, right? That you will see, right? As long as something is amiss, as long as something is amiss, okay, that's where we start to see it bring down already, right? And the market will just push it down like crazy, right? As long as something amiss, when something is so primed to perfection already. Okay, so this is the first thing. Okay, and the next thing, right? The next thing is this, and why does this actually happen? Okay, why does this actually happen? Is their guidance was bad, right? Because they say there were supply constraints down, and you know it wasn't a very good guidance. Revenue was down, and everyone was totally not happy with how Intel does it. Okay, and this brings me to why such a big company can drop, right? It's because everything was priced to perfection. Okay, when you price a company so well, you put a value to it so well that any little miss in the whatever it is, right? Okay, like very optimistic expectations or whatever, any little miss, right, guys? That's it, right? We saw that happen for Broadcom, we saw that happen for Intel, right? And again, you saw how Magnificent 7 is, right? Any little thing you miss, that's it, right? That's where there is very little room for error, and any slight miss or any negative news can trigger this sharp drop, of like 10 to 15%, right? So this is and in Intel's case, right, this is what we also see, right? So the ideal case of how we want to see a company moves is like this. We want to see a company perform this way. A company's performance is always linear one, right? You'll get better and better, but we want to see the share price increase in a linear fashion, in a parallel fashion, like how the company perform, right? So if the company performs this way, example, let's say it scales up like that. Example, the stock price, we should see the same thing. It should scale up like that as well. Okay, it should be in a way moving in the exact same direction. The gap should be about the same. So this is the ideal case that we want it to see. Now, stock price will follow the company's earnings, like this. This is what I mean. The stock price will follow a company's earnings. Okay, what happens when this happens? Where there's a lot of expectations, a lot of hype, a lot of market sentiments driving the price up even higher than the fundamentals, which is exactly what we saw for Intel, right? Everything is pushing up crazily high, and everyone is have a lot of expectations of them happening, right? This is where we say the stock price has ran ahead of the company's performance. Okay, so what happens if the companies don't meet their expectations? This is what happens, right? Where they did well, but the guidance were not good, not as what the market expects. So that is why you can see the pullback. Okay, you can see the pullback. So what happens next, right? That happens next, and this can happen in a few quarters, right? Is where a great company, they will still continue to perform over time, right? But during this period, right, the stock price will probably move sideways, because what is happening? The fundamentals is catching up with the stock price right now. Okay, and once that has caught up nicely, that is when we will see it in parallel again. Okay, so this is similar, right? Okay, why am I sharing this chart? Is because if this happens, right, Broadcom, we are also in this phase. You can see after Broadcom connect down, we are actually in this linear phase right now for Broadcom. Okay, and this applies to any companies that are at very high valuations right now, including the Max 7 companies. Well, not all of them, but practically, I would say close to half, or more than half of them actually are probably in that level of overvalue territory, right? So this is that risk that is ahead, and we have already seen this happen in big companies like Intel and Broadcom and Oracle, right? So these are the things that I want to share with all of you of what is happening. And in summary, right, if I could sum up everything I shared By the way, guys, is this helpful for all of you? If this is helpful for you, can I get all of you to type a H in the chat? Okay, so at least I know that you enjoy this kind of content. So and I can, in future I can do more of this. And if you enjoy it, if you enjoy the way I share this, I interact, just type H in the chat. Okay, H stands for helpful. It will really help me to better create more of such content for all of you lah. Okay, so in summary, right, what I want all of you to take note as we go into the market today, which probably will open a little bit red today, right? Okay, the first thing is this: don't chase what has already run, right? And then this applies to things like gold. This applies to silver, right? We have big news today that came out for both of them, right? Don't chase what has already run, because doesn't mean what happened in the past, it doesn't mean that in future will continue to run up very, very fast, right? So I want you guys to take note and take a caution into this. You don't FOMO thinking, wow, it's ran up, I missed the boat, I must faster get on the boat, right? Okay, always you got to make sure to look at the valuations, because valuations still matter in market like today. Even the best businesses can deliver weak outcomes if you buy at the wrong price, right? So don't only focus on things that are run up, right? Look at the stories. Like, I think today I gave some very great example: Broadcom, Oracle, and Intel. Just imagine if you're chasing. Just imagine that I tell you, you will be affected. You don't want that to happen. I don't want that to happen to all of you. Okay, and with all the news that's coming out so fast, right, I want you guys to also know to think in years, not quarters, right? When we invest in companies, right, we don't just invest and thinking that, oh, is it going to make me money in the next quarter, right? We want to think of it, right, together with buying at a fair value. Can it make money for me in the long term, right? Because short-term momentum fades, long-term fundamentals will compound. Okay, and last but not least, guys, there are a lot of things out there, right? Many people will tell you this, many people will tell you that, and probably you will hear some people saying that go and buy copper right now, right? Because, oh, like common sense, right? Oh, gold run up already, silver run up already. Oh, next one must be copper, right? Or some people say, oh, bronze, cause gold, silver, bronze, like the trophy like that, right? I don't know, right? But if there's anything that I can share with you is this: stay selective and patient, right? So you want to be very, very selective about the kind of companies you choose for your portfolio, because there will be many that have run up, there will be many that will be good, but at the same time there will be many that will be bad as well. So be patient, because opportunities will always be there, and it always appear when we see these kind of expectations reset, right? So in the meantime, right, take all of these things that I share with you today, all of these hidden risks that I share with you today, right? And take this into consideration as you look to the market actually for the next few weeks as well. Think about, these kind of companies, right? What do you think is a fair price that you want to own it for the long term? Right? Simple things like using the technical analysis. Unfortunately today I would love to do it, but maybe the next live I will share some technicals, because today we are running short of time. I don't want to hold up all of you. Okay. But no of these risks and that the evaluations are stretched. There are still opportunities, right? But at the same time, you also don't want to be at the stage right now where you just want to deploy all in and put a lot of your money inside lah, right? You want to be cautious of your money, and only when that right opportunity comes, and then you really strike hard. Okay, so yeah, that's all that I wanted to share with you today. I hope that this live has benefited and you guys have learned something today. And last but not least, guys, okay, just so that I can connect with all of you in the next few times, not just during the live session, right? Is, guys, come add me on Facebook. Okay, add me on Facebook over here. Okay, I would love to connect with all of you. Okay, you can scan the QR code as well. I'm also going to paste my link in the chat below, so just connect with me. Add me on Facebook, because on Facebook I do share a lot of market insights as well as some mindset knowledge that will help you regardless of where you are in your investment journey. Even if you're totally new to investing, you are just moving through life, right? I'm pretty sure that these are some of the things that you will enjoy. We really love to connect with all of you further than the live and on a more interactive basis lah, rather than 1 hour this time as well. So I'll be looking forward to seeing all of you on Facebook as well. Okay, but yeah, that's all that I wanted to share with you today. Thank you all for joining me on this next level live, and I'll see you in the next one. Okay, bye bye.